This is Realtor. What?
Yes, we're live.
Oh, tell them mortgage rates are 2.7.
I'm going to wait a couple of minutes for a couple of people to log on. It's Tuesday night. You already know what time it is. It is time for your favorite Central Florida Realtor to come on and just give you a little chat. So, like I said, we're just gonna wait a couple of minutes, give some people some time to log in, for the notification to hit and all that good stuff. So yeah, so hope everybody had an awesome day today. I had a pretty okay day as well. So thank you guys for joining in. Thank you guys for tuning in. We are so excited to be here with you guys. So for those of you who don't know, I go by the name of Joann. That is my name, right? I am your favorite Central Florida Realtor, working here in the lovely state of Florida in beautiful Orlando City, beautiful. So I've been a realtor since 2006 up in the north area, and I came down to Florida in 2013 and have been working real estate pretty much in and out, but now I'm full-time in. So so with that being said, I do this show every 2 weeks on Tuesday nights at 8 o'clock, so make sure you guys tune in. Last week we talked about new construction and, you know, the difference between new construction and a resale home. Talk to you a little bit about the benefits of new construction. And today I wanted to talk to you guys about the loan process and what is needed to, you know, how banks look at qualifications when it comes to doing the qualifications for a mortgage. So with that being said, let's get into it. So first and foremost, there are a couple of things that banks look at when they go to give a pre-qualification to a client. There's a lot of different, obviously, mortgage loans and mortgage programs out there, and that's all going to go based on an individual basis. Not everyone qualifies for the same things and the same programs. We look at things on a case-by-case basis. Now, first and foremost, I'm not a mortgage rep. I just want to put that out there. I am a realtor, but I understand the mortgage process. Hola, Viviana. Hi, Viviana. Thanks for tuning in. I'm not like I said, I'm not a loan officer, but I do understand the mortgage process. My daughter is a mortgage representative, so she, you know, good to have someone here, right here, that I can ask certain questions to. But I do understand the mortgage process. I know pretty much what the banks are looking for when it comes to giving a qualification. And I wanted to give some information so you guys can understand the process as well. Okay, so a couple things that they take into consideration when they are going to give you a pre-qualification or pre-approval for a home. Okay, the pre-qualification part is just taking your verbal information and kind of running some numbers and things like that. On that, of course, running your credit, looking at your credit and things like that, income to debt and all that good stuff. The pre-approval is once everything has been verified. So just so you kind of understand the difference on that. How are you, Viviana? If you have any questions, if you have any questions, feel free to put them in the chat. You know, leave a comment and I'll go ahead and get to it. I can't probably see it, but I'll put on my glasses so that I can see. But anyway, a couple of things that they take a look at when they are doing the qualification. First and foremost is your income, okay? Couple of things when it comes to that. Have you been working 2 years on your job? That's extremely important. You need to have 2 years of income in order to, first of all, start the qualification for the job, for the loan. Second thing is, of course, if you're getting paid a W-2 or if you're getting paid a 1099 for those of us that are self-employed. They look at things differently, and I'll go into those in just a little bit. But income is the first thing, obviously, that they look at, okay? And of course, if you have 2 years on the job, okay? The next thing that they're going to look at is your debt. How much debt do you have? And when we talk about debt, we're not talking about the full amount that you may owe on things like your credit card, student loans, other loans, things like that. They're not looking at that. They're looking at what is your monthly obligation. So if you have a car payment, if you have credit cards, student loans, or other loans, anything like that, of those things of that nature, they're going to look at the monthly obligation. So for example, if you have a credit card and you have a $5,000 balance, right? I'm sorry, $5,000, balance that you owe. They're not looking at the full $5,000. they're looking at your monthly obligation. So maybe it's $100 a month. I don't know. I'm just using that as an example. That's the number that they're going to use to base your debt on. Now, before I continue on, I do want to let you know that the lower you are with your credit card balance, obviously the better off you're going to be, because your debt to income ratio is going to change a little bit. But what they're going to look at is, try to keep your balances below the 30%, because that's also going to increase your credit score. But we'll talk about credit in just a little bit, okay? So the debts, that's what they're going to look at. Monthly obligation when it comes to credit cards, car payments, loans, student loans, things of that nature. So your income versus your debt. And then they're going to come out with a ratio. I'm not going to get into the ratio numbers because it does get a little bit complicated, but just know based on those ratios is kind of more or less where they're going to figure out what you qualify for as far as how much house you can buy, how much buying power do you have. That is what they use the income and the debt to determine, okay? The next thing that they're going to look at is obviously your credit. What score do you have, okay? So for the most part, for FHA purposes, okay, you need a minimum of a 580 credit score. Now, keep in mind that things can determine that. High balances on your credit cards. If you lower balances, those scores can increase, so on and so forth. Late payments on your credit cards or any other of one of your loans. Try to have at least 12 straight months of on-time payments. That's going to help you. Things like that. If you have a mortgage already, you want to refinance, these are things that they're going to look at. Make sure you're not late on your credit card payments, your mortgage payments, car notes, things like that. Try to be on time for at least 12 months. Okay, so the credit score is going to determine what program you can qualify for. So your debt and your income is going to determine how much buying power you have, and your credit score is going to determine what program you will qualify for, okay, and what interest rates you'll qualify for. There's a lot of incentives for having, higher credit than normal 580, which is what is normally required for an FHA loan. Now, keep in mind, that is standard for the government to say that you need to have a 580. However, with COVID and everything that's been going on this last year, the banks themselves have set certain requirements as well, where they're also now requiring some applicants to be at a 620 or above. So it all depends on which bank you're going to use, and things like that. It's going to determine whether or not they will accept the 580 or 620 and above, okay? Now, the benefits of having a 620 and above is obviously you're going to be qualified for better programs. Programs such as down payment assistance, which is probably, I think, 640, 660 and above. So the more, the higher your score is, the more programs you're going to qualify for. But things like down payment assistance programs, the Chenoa program, USDA programs, which are 100% financing, things like that. It's also going to give you better rates. Someone that has a 580 credit score is going to pay higher interest rate and higher mortgage insurance than someone who has a 640 or 660 and above. Okay, so those are things that you have to look at. Those are things that the bank looks at when they go to give you a qualification. And the reason I'm explaining this to you is because sometimes I hear clients and they say, well, my cousin has 2.75 interest rate. Sorry, my dog is barking. That's great, but your cousin probably has a 700 credit score. You know what I'm saying? So I can't say that because I have not analyzed or looked at what your cousin has. I'm just going on your basis, on your, like I said, individual basis. Again, because it's a case-by-case basis. Every client is different. There's no two loans, no two house purchases are never going to be the same. It just does not happen because there's so many different factors and deciding factors that go involved into that, okay? Like I said, debt and income is going to determine how much you can qualify for, and your credit score is going to determine what program you will qualify for, okay? If you don't have great credit, no problem, because we do work with an amazing credit repair company that can help you, and we will give you the steps that you need that to help you get to where you need to be. The most important thing is to start, because we need to know where you are today so that we know where to take you at tomorrow, if that makes any sense. If that makes sense, give me a thumbs up. Even if this is a replay, give me a thumbs up as well. So yeah, debt and income. The other thing is obviously how much cash do you currently have? How much cash is needed to make this purchase? So If it's a primary residence and you are looking at an FHA loan, which is probably like the most common that is used, the FHA program is governed, is backed by the government, and it allows people with lower, well, I don't want to say lower income because that's not really the right word, but it allows you, thank you, it allows you to put in the least amount of possible, which makes home ownership possible for everyone, okay? So the minimum that is required would be a 3.5% down payment. So what does that mean? If the house price is $200,000, 3.5% of the $200,000, in this case, I'm a numbers person, that's $7,000. So that's what you would need to put down for your down payment. Do we have that money in hand? Is it in your bank account? Where is it? Is it in a 401k? Is it in a savings? Is it going to be a gift from someone? Things like that. So there's ways to go about getting those finances that you need. But I want to give you those simple numbers. Again, $200,000, 3.5% for an FHA loan, you need about $7,000 for that. The other part of that is your closing costs, okay? Your closing cost is about 4% of what the house price is as well. So with the closing cost is paying everybody that's involved in the transaction. Now, if you've watched some of my shows before, you know that we talk about there's about 20 to 25 people that are involved in one transaction of a real estate transaction. Not only do you have the realtors, it might be two realtors. Hey, Erica, thanks for tuning in. You have your loan officer, you have your underwriter, you have the appraiser, you have the inspector, you have the county. There's so many people involved in one transaction. Everybody gets paid at closing. But we don't make any money up front. We can work with you for 6 months to a year and not make a dime until the day you close your house. Okay, so again, 4% of the price of the house is what is considered for closing costs. Could be a little less, could be a little bit more. Usually depends on taxes and your homeowner's insurance and things like that, because those things can kind of offset some of those prices. But everything like your taxes get paid. If there's an HOA on the property, those things get paid. Your mortgage insurance, your everything that needs to get paid gets paid at the close with closing costs. Now, using the same scenario of a $200,000 house, you're looking at 4%, you're looking at another $8,000, okay? Now, don't freak out. We're talking $15,000 between your down payment and your closing costs. If you have it, great, wonderful, not a problem. But if you don't, that's why you have me, the professional, your favorite Central Florida realtor, right? That can help negotiate some of those closing costs with the seller. Okay, if it's a new construction, it may be covered by the builder, but if it's a resale home, then I can negotiate some of those closing costs to be paid either all or partial of that amount by the seller. Okay, that's why you hire a professional to do that, so that we can do those negotiations for that. So that way you're not coming out of pocket with another $8,000. Like I said, if you have it, great, wonderful. If not, let us, the professionals, negotiate some of those costs for you. Okay, so income, debt, your credit, and how much cash you have. Those are things that the bank is going to look at when they're going to give you the pre-qualification letter for your purchase. Now, again, the pre-qualification is going to be an overview of everything that you stated. They're going to look at your credit. They're going to look at all your scenarios. They're going to take into consideration all of that, everything that you've told them as far as how much income you have, what do you make, all that good stuff. The pre-approval is once everything is verified. So they will then at that point ask you for your taxes, for your W-2s, for your, if it's a 1099, they'll ask you for a 1099, your pay stubs, your bank statements, your social, your driver's, everything that you need to prove everything that you told them previously. They're going to take all of that and verify everything that you said, and then they can give you a pre-approval. So if all the numbers match and everything matches based on what you told them, then you get a pre-approval, which is a little bit more secure than a pre-qualification, okay? So those are things that they're going to look at, like I said, when it comes down to getting a pre-qualification for the mortgage. Now, I gave you the scenario of an FHA loan. I don't want to get too much into details with all the other programs, but just know the higher your credit score is, you can qualify for different programs. Like I said, the USDA program is 100% financing. It's only in certain areas. Not all areas qualify for USDA. only certain areas, and your credit score needs to be a little bit higher. Also, the down payment assistance program as well. You can qualify depending on your debt to income ratio, but just keep in mind, and I like to say this all the time, right now, currently, the rates are about 2.75. I just asked my daughter and she told me they're about 2.75 today. But interest rates change on a daily basis, okay? So just keep that in mind. So when that happens, hey Elizabeth, thanks for tuning in. If you have any questions, feel free to leave a comment. The interest rates change daily. So I always like to let people know, if you're trying to get down payment assistance, that's wonderful. And if you qualify for it, or if the area qualifies as far as USDA, things like that, that's wonderful, that's great. If you have the credit and your debt to income is on a good ratio, that's great. However, keep in mind that whenever they're giving you something, they're gonna charge you on the other side. So what does that mean? As I mentioned, you have a 2.75 interest rate today. If you qualified for the down payment assistance, your rate is going to be a little bit higher because they're going to charge you a little bit more. Maybe 3.2, maybe I don't know what it is, but they're going to charge you a little bit more. So what that means to you is that your that same $200,000 house, okay, your payment is going to be a little bit higher, and you may now even qualify for less because your monthly payment is going to change. You understand what I'm saying? Hey, Chris, thanks for tuning in. So that's something to keep in mind. So if you're if you're trying to get down payment assistance, just know that the rate is going to be higher, which means that you most likely, thank you so much, you most likely will qualify for less, okay? So let's say you qualify for $200,000 on a regular FHA program. If you're going for a DPA, down payment assistance, you may now only qualify for $180,000. So keep those numbers in mind and keep those things in mind. And again, I wanted to come on here real quick and talk about these things because, again, I hear a lot of times, oh, well, my cousin this and my sister that, and that's all great. But remember, the mortgage qualification is on a case-by-case basis. They're not all going to be the same. So that's pretty much that. We do have down payment assistance programs. We have all the programs that you need. Like I said, my daughter is a mortgage rep, and she can certainly help any one of you get qualified. If you don't have great credit, not a problem. We can help you with that and kind of gear you in the right direction on what you need to do and exactly where, what steps you need to take to get you to where you need to be. And if it's, hey, Marco, thanks for tuning in. And if it's something that you're at a 580 and you want to stay there and go for an FHA loan, wonderful. If you want to wait and try to bring yourself up to 620, 640, 660, we can certainly give you the steps needed for that. And if it's something that needed a little bit more credit repair, then obviously we have the company that can help you with that as well. So let me know if you guys have any questions, and I really hope that this was very helpful. I try to keep these lives every other Tuesday. It's from 15 minutes to an hour. I do have the hour slated, but if nobody has any questions, then I kind of just keep moving on. But I really hope that this was very helpful. For those of you who are just now tuning in, go back and watch it from the beginning. We're talking about the mortgage qualification. And yeah, remember guys, right now the rates are 2.75%, which is amazing. That's today's rate. It could change tomorrow, but as of right now, it's 2.75. So for those of you, if you have a house already, it might be even a good time to think about refinancing. If you bought your house about 2 years or more ago, if you bought your house, you're probably looking at, if you bought your house 2 years ago, you probably got it around 4.4% or 4.1, anywhere around there. It might be a great time to try to refinance it and bring it down. Thank you, Vivian. I'm glad you thought it was helpful, and bring that rate down from 4.1 to 2.75. We had a client about a couple of weeks ago that went from a 4.1 to a 2.25% rate. I mean, amazing rate. She did a refinance on her house, and that dropped her mortgage payment dramatically. So, think about that over 30 years. That's amazing. So with that being said, guys, I really hope, I hope you guys have an awesome night. Thank you guys for tuning in. And if you guys want any more information on anything that I talked about tonight, feel free to send me a private message. If you want a personal consultation, feel free. We can set that up. I believe I have the Calendly up on my profile. If not, send me a private message, and I'll be more than happy to meet with you guys on a one-on-one basis. I'll bring my mortgage rep, and we can certainly start you on your road to your first home, second home, refinance, whatever it is. I'm here to help. I want to be, if I'm not already your favorite Central Florida realtor, you already know that I want to be your favorite Central Florida realtor. So with that being said, thank you guys so much for tuning in. Again, we covered financing today, how to get qualified for a mortgage. So for those tuning in, go back and watch it from the beginning. And with that being said, I'll talk to you guys later. Feel free to hit me up. And if you have any other questions, I'm here for you guys. All right. Thanks. Bye-bye.